Good morning, Edgar Denny here. It's January 23rd. Hope you've had a good weekend and hope we can look forward to a decent week. It's starting out pretty nicely with the market. Well, the S&P is up about 40 points, which is a nice way to start the week. And it's an interesting that the market is up this morning because we had the index of leading economic indicators come out, and they were down a lot. They were down like 1%. Maybe we're starting to see that all this, we're kind of all getting exhausted about arguing whether this is going to be a soft or a hard landing. Market doesn't seem to be particularly concerned about a recession this morning, even though the leading indicators was down so much. We did address this issue in the morning briefing, and let's go have a look at some of the charts that are relevant to that. Oh, am I muted? No, I shouldn't be muted. Is anybody having a problem hearing me? I got a question here from, are you muted? Anybody else having a problem hearing me? Just send me a question or on the Q&A. I guess that maybe, let's see. I'm good. Okay, never mind. I got it. No more. Thanks. So whoever thought that I was muted, give it another chance on your end. Maybe there's something on your speaker. All right, so let's go where we wanted to go here and look at the charts for the morning briefing. I did focus in the morning briefing on the leading and the coincident economic indicators. I try to kind of assess what they might do this morning. And I think we got it pretty much right that there would be a big drop in the LEI. We also thought that there'd be sort of a flattening out in the index of coincident economic indicators, but that was the case. It was up only 0.1%. I did have someone email me this morning that when you look at the leading economic indicators, particularly on a year-over-year percent change basis, you have to take into account that a year ago and 2 years ago, there was a tremendous amount of stimulus provided in fiscal and monetary policies to the economy. So when you do year-over-year comparisons, sometimes it tells you as much about what happened a year ago as what is happening currently. So we'll see that in a minute, that the year-over-year LEI looks pretty awful, but then the actual level on a kind of concurrent basis for the LEI doesn't look particularly good either. So let's have a look. So here you go. We're looking at the chart that we have in the morning briefing. Let me reduce it a little bit with the touch screen here, the magic of touch screen. And you can see that the leading economic indicators goes back to 1959. It didn't do a particularly good job of anticipating anything back in the first recession here, but the previous 8 recessions that we've had, it led by 9 months, 10 months. If you just average this all out, you get that the leading indicators gave you a 12-month average alarm that something was amiss with the economy and that we were likely to have a recession. Well, the LEI peaked in February of last year, and so if you just take the average, that would imply that we're on the precipice. We're going to have an imminent recession, and that it'll start in February, March, maybe April, but it's getting awfully close. And it does do what it's supposed to do. It does lead the coincident economic indicators. There's 10 components of the LEI. There's 4 components of the CEI. And you can see the CEI does a pretty good job of, on a coincident basis, telling you when recessions are just starting. This is the peak in the business cycle here. Notice how it really coincides with the official shadings for recessions, and then it tends to bottom, not always exactly when the recession is over officially, but awfully close. So again, this is giving us a warning sign of a recession. When you look at the year-over-year percent change in the LEI, what you can see is that we're down here at minus 4.5. Now, let me just jump over here to the today's update of these charts, and you can see that it looks pretty ugly. LEI is continuing to come down sharply. It's down 1% in December. When you look at the year-over-year percent change, here it is. Here's the LEI versus real GDP, and you can see that the LEI is down 7.4%. So it's down about as much as it was back during the lockdowns, and it's definitely in recessionary territory. Let's go back to the charts of the morning briefing, and we can see the components of the leading economic indicators. We've got the average work week in manufacturing. One of the points I make in the morning briefing is that the LEI is very weighted towards manufacturing. It's got 3 financial indicators, and it's got 7 non-financial indicators. And of those 7 non-financial indicators, 4 of them basically relate to manufacturing. Nothing wrong with that. Manufacturing tends to be more cyclical than the rest of the economy. So if you want a leading indicator of the business cycle, you certainly want to give weight to the areas of the market that are going to be the areas of the economy that are going to be weighing most on the LEI as you're approaching recessions. But the economy's also changed, and we've got services has also kind of got some cycle into it these days, and it's become more important than the economy. So it's conceivable that we could have quite a bit of weakness in the good side of the economy, but the services and maybe other parts of the economy offsetting that. And I think that's kind of the story I'm telling here, is that we have seen consumers pivot away from goods, buying more services. So it's not surprising that we're getting a lot of weak indicators for the good side of the economy. So the average work week in manufacturing has been kind of coming down. Let me go back again to this one, because we might as well look at the most current ones. So here they are. And again, let me narrow it down a little bit. So this is the numbers that came out this morning. Thanks to our crude artificial intelligence program, our charts are automatically updated as soon as our data vendor has the data. So this was updated like at 10:01 or within a few seconds of when the data became available. So you can see that the average work week in manufacturing is rolling over. On the other hand, initial unemployment claims remains historically low, but it upticked a little bit, no big deal. Now here's where we get more manufacturing. You see, you got consumer goods, and that actually went up in December. And then we've got another manufacturing here, the ISM new orders index, that went down sharply. Non-defense capital goods orders kind of flat. Building permits still falling. The S&P 500, I guess it uptick a little bit in December. And then there's something called leading credit index, which is a proprietary index that the conference board puts together, and it's not doing much of anything. And then there's the interest rate spread, which the conference board still uses the 10-year minus the Fed funds rate. I would rather use the 10-year minus the 2-year, but taking it as they present it, you can see that when the Fed raised the Fed funds rate by 50 basis points in December, that inverted this version of the yield curve on a monthly basis. So yeah, we know that manufacturing is weak. That's confirmed by all this. We know that the labor market's doing pretty well. That's confirmed by jobless claims, though we are seeing some weakness in the amount of hours. I think part of that is a lot of workers who were able to work during the pandemic wound up having to work overtime because there was a real shortage of labor. And as labor is being hired, maybe that's reducing the average work week, overtime, and all that. Okay, let's go back. I may be jumping around a little bit. Hope I'm not making you dizzy. Yeah, the rest of the most of the rest of the charts here are showing you the leading economic indicators. There's building permits. We know that's down sharply and could very well continue to move lower. But at some point here, we're probably going to see that housing activities kind of hit the basement. It's gone as low as it's going to go. But there's probably more downside. This is the ISM manufacturing new orders. That is the latest data through December. On February 1st, we're going to get an update for January. And so far, we've got New York and Philadelphia regional business surveys, and they suggest that things are going to remain weak, but not as weak as we've seen some of these lower numbers, at least for January. The interest rate spread we've mentioned here, and again, you can see that the so-called official one in the Conference Board's version of leading economic indicators is finally inverted, but we know that in June of last year, the 10 versus 2-year inverted. Okay, let me jump some more here. Yeah, we've looked at these already. Oh, this is an important point here on the financial. So we've got the S&P 500. We've got the leading indicators as two financials that are in the that are in this indicator. Let's look at there it is. This is an important point that I've been making, and it's either going to be right or it's going to be wrong. The idea is, okay, so the yield curve is inverted. The 2-year yield has come down. These are pretty good indicators that the fixed income markets believe that the Fed's monetary tightening policy cycle is pretty close to an end, that the Fed has done enough to slow things down, to bring down inflation. And so we have the inverted yield curve. And in the past, inverted yield curves would predict recessions. And we've discussed this many times. I think what the yield curve in the past really has done is anticipate that if the Fed continues to tighten and raise interest rates, this was before the time of quantitative easing and tightening, but that if the Fed continues to raise interest rates, that something will break. There'll be a financial crisis. And that financial crisis may be very specific to one institution or to a bunch of institutions, a bunch of banks, S&Ls, and so on. And suddenly it becomes an economy-wide credit crunch, which means that even good borrowers can't borrow because the banks are scrambling to provision for loan losses, and they've turned much more conservative. So when that happens, that credit crunch, it's that credit crunch that causes the recession. So yeah, inverted yield curves have a history of predicting recessions, but what they really predict is as a process, financial crises lead to credit crunches, then lead to recessions. I think what's different this time, and I recognize that's always a dangerous thing to say, can be a real jinx, a contrary indicator for some. But what is, I think, different this time is the credit system is in much better shape. And so here we've gone from basically zero Fed funds rate. We're heading towards, with 3 more rate hikes, let's say 25 basis points each, we'll get to 5.25% by May. So that's a huge increase in the federal funds rate. And despite that, I don't think we're going to get a credit crunch. We've had financial crises already in the sense that the cryptocurrency markets had some crises. The SPACs have had some crises. The meme stocks have had some crises. Stock market's down a lot. The bond market's down a lot. A lot of wealth has been destroyed last year. And yet, despite that, we're really not seeing a credit crunch. As a matter of fact, C&I loans are at an all-time record high. Consumer credit, the revolving credit's at an all-time record high. So there's no sign that I see, or very, very few signs of a real credit crunch. Now, you could come back to me and say, well, just wait. It's going to take some time here. There's a long and variable lag between what the Fed does and the economy. And there's going to be all these zombie companies that are going to try to refinance at much higher rates, and that's not going to it's not going to be no, they're going to fail. Is the pessimist view. All these leveraged loans are going to blow up, though. Leveraged loans really didn't blow up anywhere near the way that one would have expected during the great financial crisis. So, you know, that may not be an area where calamity occurs. But so far, so good. So far, no economy-wide credit crunch. And that's why I'm focusing on this leading economic indicator. I don't really know how the conference board puts it together, but I prefer my kind of comparable indicators of a credit crunch. And you can see that, just want to see here. You can see that in the S&P 500 VIX, the S&P 500 VIX versus the high yield corporate spread. People have been wondering why the VIX hasn't gone a lot higher, and you can see the correlation with the high yield corporate spread is really pretty tight, and both of them are telling you, you know, don't worry, be happy. So as is this indicator. I mean, this indicator suggested that credit conditions were very well. They're suggesting that they're getting tighter when you is the way this thing is created compared to where it was here. But again, I think this is a more sensible way to look at it. But I've got to look at this one because it's in the leading economic indicators. Now, how about the coincident economic indicators? Well, there's four of them. And again, let's go to the updated charts here. These are the four components: payroll, employment, real personal income less transfer payments, manufacturing and trade sales, and industrial production. And these are updated through December. You can see payroll employment up at a record high. Real personal income less transfer payments. Maybe now we want to, it kind of looks kind of flat, right? Hasn't really done much of anything. This is interesting. This is manufacturing and trade sales adjusted for inflation. And that looks like it kind of ticked up just a little bit. And then industrial production, we know, was down a lot in November and December. But the offset was payroll and employment. And so net, you had a 0.1% drop in the coincident economic indicators, not drop, increase, increase. So we went to an all-time record high. Going back to the chart here, so we were able to conclude that that's what would happen, that there would be sort of a stabilization, a flattening out of the CEI, because of our earned income proxy was indicating that wages and salaries adjusted for inflation were kind of leveling out here, and that's an important component of personal income. The CEI, as you can see, we can put them on exactly the same scale. See, 20 minus 20, 20 minus 20. And you can see that it's a pretty good proxy on a monthly basis for what's going on with real GDP on a year-over-year basis. So we're still in positive territory on a year-over-year basis. We're not in a recession environment. I mean, I think if this thing actually turned negative on a year-over-year basis, I'd have to conclude that the hardlanders were right, and that the soft landing scenario is not working out. There are other leading indicators that I look at besides the so-called official one that the conference board puts together. So figure 14 here, this is the year-over-year percent change in the coincident economic indicators again, this time against our favorite, one of our favorite stock market metric, which is forward earnings. And you can see that forward earnings have come down a great deal. I think they're up like only 1.2%. They haven't turned negative on a year-over-year basis. We're thinking something more like this, sort of a mid-cycle slowdown. This is a mid-cycle slowdown that occurred here in the growth rate of forward earnings. There's a mid-cycle slowdown here. So that's where we are. The pessimists obviously are saying that earnings are going to take a dive, kind of comparable to what we've had in previous recessions. And so there's more downside to the market, and we're going to blow through to the downside through the October 12th low of last year's bear market. So it will be a continuation of the bear market, whereas our position is October 12th made the low for the bear market. Here's another chart showing forward earnings versus real GDP. Again, we're using forward earnings now. It's sort of a leading indicator. It may not be that much of a leading indicator when you look at this chart relative to Coincident, but it's available weekly. So at least from a time perspective, we get a more current view of what's going on with the economy from forward earnings. A couple of more fun charts here on leading indicators, and then we'll open it up for a little discussion, Q&A anyways. So you can see here's the an interesting chart showing leading economic indicators, and we know that that's continued to decline, versus payroll employment in the truck transportation industry. Look, we're constantly looking for indicators to do our job, and so that's one that we came up with, and you can see that it does a pretty good job of being coincident with leading indicators, and so far it's at an all-time record high. Go figure. Something that looks a little bit more on the weak side is payroll employment and temporary help services, and again, it tends to be pretty coincident with leading indicators, and here they're both coming down. So that's something to kind of put on the if you're doing pluses and minuses in terms of thinking of the economy, that's on the negative side. LEI versus the manufacturing PMI, year-over-year percent change in LEIs, very highly correlated with the MPMI. And again, the LEI has a lot of weight to manufacturing, so it's really not that surprising to conclude that we've got weakness in the manufacturing sector. Again, our story is kind of a rolling recession, mid-cycle slowdown, growth recession. Any one of those phrases kind of fits the way we're looking at things. And that's where we think we are. We think the recession has rolled through the goods industry. It's rolled through retailing, but the services economy is still doing quite well. It's rolling through single-family housing activity, but multifamily is doing relatively well. Fiscal stimulus is still, there's plenty of it in the pipeline. So that's keeping the economy growing. And the consumer, all in all, still has jobs and continue to spend, maybe not as much on goods, but more on services. By the way, we're also, Joe and I are always looking at forward earnings, not only for the S&P 500, but by the industries. And this is kind of an interesting one. This is forward earnings for the S&P 500 versus the air freight and logistics forward earnings. And mostly because of FedEx's announcement that things were not working out too well on the short term, we had a big drop in analyst consensus expectations for earnings using forward earnings. And that's worrisome. But I think it's really more an indication of the global economy. And there was a lot of pessimism about Europe and China only a couple of months ago, and now that's being relieved by perceptions that those parts of the world are doing better. So that's my rambling thoughts. Hopefully I didn't talk too fast and it all made sense, or some of it made sense. Why don't we make sense of some of the questions you're throwing at me and try to see if we can come up with some sensible answers. Yeah, I've got 2 questions so far. So why don't you, if there's some more, throw them my way, but we'll start with Devin. In your opinion, can S&P 500 maintain a forward PE of 16 to 19 if the Fed funds rate remains above 4 for the next 12 to 24 months? I'm under the impression that historically above average PEs are not maintained for extended periods of time if the risk-free rate is at certain levels. I mean, that's a very good point, and that's one of the issues we have to deal with here is I think we are transitioning to a new, not a new normal, but away from the new normal of unconventional, easy monetary policies from 2009 to 2021, let's say, back to an old normal where the economy can grow. Inflation isn't necessarily 2%, maybe it's higher than 2%, maybe it's more like 3%, but central bankers want to get it down to 2%, but they may have to be somewhat flexible. And anyways, they're talking about 2% in 2025. So we'll have some time to update our views on that. But the main point here is that the PE is high relative to interest rates, and there is potentially more downside to the valuation multiples. But in a soft landing scenario where there's still ample liquidity, I know this is a controversial point. Every time the stock market goes down and the bond market goes down, the argument is, see, liquidity has dried up. This is the Fed tightening and QT. But let's not forget that there's a tremendous amount of liquidity that's been poured in to the system during the pandemic, and some of it is still there. A lot of it is still there. M2 is still about $1 to $1.5 trillion above its pre-pandemic uptrend. We know that there's a lot of stimulus in the fiscal pipeline from all these infrastructure and semiconductor building allocations that were made by this administration and passed by Congress. So you put it all together, and you can see the way the market trades. Whenever we get into a blackout period for the Fed, where they sort of have a gag order, they can't talk. Well, we can all kind of breathe easier because we don't have to put up with all this chatter from them. But during these periods, the market seems to be able to move higher. So we're in a blackout period now. It started on Saturday, and I'm looking at the market. It's up 52 now. So a bullish development is when the Federal Open Mouth Committee has a gag order that they can't talk until after the next FOMC meeting. So, I mean, Powell's going to talk on February 1st. So that's really the end of the blackout period, if you will. But all in all, the market's doing pretty well, holding up these kind of valuation multiples. I think if we fell into a hard landing, and if inflation really was turning out to be persistent, it just won't come down, and the markets conclude the Fed really is going to have to raise interest rates a lot further. In that scenario, you'd have a hard landing, and you'd have the PE going down a lot more along with earnings. But that's not my scenario. And I think, earnings are going to grow. I think they're going to be up this year, which is a fairly contrary view. I think a lot of strategists are flat to down. I'm at $225 per share for this year's S&P 500 earnings. And I've seen some charts of strategists, and the most optimistic was like 220. So that's close to 225. But there were a lot around 200 and some even less than that. Okay, Willem, how worried are you about the debt ceiling? Well, I have been asked a lot about that. I'm sure we're all thinking about it. It's making the headlines. The government has run into its debt ceiling, and Janet Yellen, who graduated from Yale 6 years before I did, I read her famous Yellen notes that helped me get through Yale and to understand Tobin's lectures. But Yellen has said that they're going to have to take extraordinary measures that could keep them going through the early summer. And so we're going to have this hanging over our heads until the early summer. But look, I think the market is pretty relaxed about it. I think the market's perception is this too shall pass. We've seen this before. This is a game of chicken that they regularly play in Washington. Now, maybe this time push is going to lead to shove, and there won't be a deal in the last minute. We clearly have seen the Republicans So the right wing of the Republican Party deal with the election of the new speaker by imposing some pretty significant demands. And maybe there's something in there that's going to make it impossible to do a debt deal. In which case, the stock market will take a huge dive for about a week. The bond yield will go up dramatically for about a week. The policymakers, the politicians will get the message and they'll get scared and they'll do a deal. So, and then that will turn out to be kind of like Brexit, a 2-day buying opportunity rather than something more cataclysmic. So that's the way I'm looking at it. Well, it looks like that's, oh no, let me scroll down here. I guess a few more came in, yes. Okay, William, do you think government actions like the CHIPS Act help or hurt the economy over the long run? I'm a fan of free market capitalism, and I'd rather have the markets solve these sorts of problems. But I'm also a realist. Governments are here to stay. They're getting bigger. They're getting more intrusive into their impact on the economy. There's more industrial policies. There's more politics involved in the way our economy operates. Yet we still have on balance, we have a good capitalistic economy, and I've often observed that I'm impressed by how well it's doing, despite the politicians, despite Washington. So it is what it is. Again, it's a theoretical question whether the government is hurting the economy or not. Again, I think it would be better if the private markets did it, but the government is involved, and there are all sorts of issues, the geopolitical issues when it comes to semiconductors related to our Cold War with China and so on. So it is what it is. It's kind of my lame response. Sorry about that. Devin, thanks, Ed. Great points on liquidity levels. Yeah, I think that's a fairly contrary and odd interpretation of what's going on here. There is a perception that liquidity is dried up, but I think there's a tremendous amount of liquidity. Let's not forget, a lot of corporations borrowed at record low interest rates during the pandemic, and so they're not doing too badly. And it may be that what I'm missing here is a long and variable lag in monetary policy, and it's maybe we'll have a recession in the second half of the year. That seems to be still a consensus view. It's Jamie Dimon's view. We'll run out of excess savings, and the government, once we run out of excess savings, that's when the consumer goes into retrenchment mode. We'll be watching it along with all of you and see how things play out. But you know what our position is currently. So with that, have a great week, and we'll see you next week. Goodbye.